run two funds in Canada. We run a liquid managed futures mutual fund, and we run an all-weather ETF and mutual fund that basically incorporates managed futures as one of its strategies, but it has a robust exposure to multiple other things. Gold is an example, because the volatility will dampen out because of the lack of correlation. So you can trade long duration bonds, you can take higher beta stocks in your portfolio. You can hold things that individually advisors would find hard to hold because of the volatility. But when you package them together properly, you can achieve an outcome for those advisors. So that's what we do in Canada. And the one thing that I think we can all agree on is when we look back at our lives, when you resist things, things don't work out. When you go against your intuition, things don't work out. When you follow the inertia that's naturally in front of you, things will often work out over time. So with that, I want to talk a little bit about the managed futures industry and why it's important. But the structural foundations and the statistical foundations of trend following are very, very clear. There's a book, if you haven't read it, 2004 book by Benoit Mandelbrot, The Misbehavior of Financial Markets, where he gave a really elegant description of the development of efficient market hypothesis, and then started poking holes in it by talking about how the world is not so simple and neat. It's much more turbulent, it's much more fractal, and we all know these things. We're able to demonstrate over and over again that markets have leptokurtic distributions. It's true. How we explain that in common sense terms, I don't know. But that is a fundamental feature of how markets trade. Time series that have a slight tendency to mean revert, or time series that have a slight tendency to be trend persistent. You don't know when it's going to switch regimes or for how long. But if you apply trend following systems to any time series that has a little bit of trend persistence in it, or a leptokurtic distribution, they always make money. It's a statistical feature of markets because it's a complex system with multiple factors, multiple interdependencies, and positive and negative feedback loops. But I think the most important thing that I can say about our industry is that our fundamental source of return is structural in nature. It will not go away. It's just embracing risk and understanding trends, following inertia is important, not just in financial markets, but in life. You know, I'm always reminded of Yogi Berra's line, you know, when you see a fork in the road, take it. He didn't say which fork, he just said take it. But every decision we make is a fork in the road.